Welcome everyone to the Kendall Report, where I share my 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, I'm going to cover the craziness that we've seen in the last 3 days and what it means going forward. I think you'll be surprised at my analysis. Let's get into tonight's video. Over the years, I've seen a lot of markets, and I tend to approach things as a contra-trend trader, especially on a short-term basis. What we witnessed over the past 3 days have been quite extraordinary in terms of market declines, but not some of the biggest ones. As always, I emphasize when I mention specific numbers in my Substack or on YouTube, they usually hit the mark, and they hit there the next day or very soon. In just a moment, I'm going to show you a video clip that confirms this was a climactic moment. Now, I'm not saying it won't see lower prices in the future, but the patterns still show upward slopes on a long-term basis, and you'll see that here briefly. Tonight in this video, I'm just going to focus on the S&P, NASDAQ, and interest rates, and I'll walk that forward. I'll go through everything in depth as usual on the Substack, so make sure you go there, which is kendallreport.substack.com. The clip I'm about to show you is a perfect example. It's a classic case as the sky is falling, hysteria from talking heads on the TV, most assuming claims that the NASDAQ had never been down 1,000 points before. For some context, back in 1987, the NASDAQ dropped 11%, 11.8% to be exact, in one day. Yesterday's decline was 6%. It was 1,000 points, but the number sounds bigger than it is, so that's why the media went with that. Yesterday's movement, like I said, was half of the historical drop. This is a prime example of how statistics and numbers can be used to create sensationalism in a financial media. Let's watch the video.
The Dow opened down more than 1,000 points, fueling fears of a recession amid a global market meltdown.
Quadruple-digit loss now in the Dow. 1,000 points.
Never been down 1,000 points ever, not even intraday on the NASDAQ.
Is that true?
That is true.
A rise like that is historically a sign that a recession is imminent.
The economy is either in or close to a recession.
What you're seeing right now, the stock market, is what Americans have been feeling for the last 3 years. It's just a manifestation of it right now.
Take a deep breath. It is very scary.
Another point worth mentioning, I had the opportunity to work at Merrill Lynch under Bob Farrell in the research department, one of the most renowned analysts in the firm's history. Bob often emphasized that the importance of paying attention to media bias. When you see everybody screaming the same thing, it's often a signal to consider the opposite view. Now, I talked about before that I tend to be a contrarian trader, especially intraday and day trading. I would tend to take the other side around key points, but I've also talked to you about paying attention to the loudest noise in the room. And without a doubt, this was the Japanese carry trade. Throughout this clip, it doesn't cover that, but it does highlight how yesterday's decline was portrayed and the beginning of something much bigger. But when everyone says it's the beginning, it's very often the end, marking a climactic part of a sell-off. I'm going to go through the analysis. I'm going to stick through a lot of the longer-term trends. That being said, I do believe there's been a lot of damage done, and it's been significant, and it will take some time to repair. So this isn't going to be over in a few days, but we're already seeing a pretty decent bounce off the lows yesterday, and overnight we're seeing buying coming in again. Despite this correction, it's still going to be very dynamic. There's going to be a lot of trading opportunities. Just another mention before we get into the current analysis, the recent climactic move happened much faster. Just like I told you, it took just 3 days. Ties into the broader phenomena that I've been discussing about market behavior and the influence of the millennial traders. I'm not saying this is bad. I'm saying its sheer volume of participant causes these rallies to extend and the sell-offs to extend. In today's session, the sell-off extended early. There was one more leg down, thought it would hold, but it had one more leg down. It caught a bid, bounce back, and overnight we're seeing that further bid. So in this video, I'm also going to be, as I mentioned, just focusing in on the monthly charts for longer term market scenario. And once again, in the Substack, I'll go through the micro analysis and talk about some of the things that I think will unfold over the next couple of days. Let's get into the analysis. All right, starting off with the S&P, we're looking at the monthly chart here, and this is actually portraying, you can see there's still an upward angle of attack here. Trends are still in place. It doesn't look like it is the end of this trend just yet. The forecast on the S&P, you can see here, I'll blow this up so you can see it, is for at least a couple months of recovery, probably coming back into the middle of the range. And then it is suggesting that we're going to come down and test some of these other support levels, potentially going back to 5,000, and ultimately maybe the market will come into a pattern where it will trade within this declining 10-month moving average and the rising 40. So we're looking at an area here of actually setting up a support zone. But the market that's going to unfold will be very methodical, and it's going to take multiple months. But I do believe we started something fairly big. We should set up a right shoulder, some consolidation around this rising 21. Ultimately, we'll see a rollover. We'll take a look at the algos. You can see they're forecasting rollovers as we come in around the election and and beyond as we come into Q4. This is where it looks like things are going to roll over. So the overall patterns, though, still intact. Doesn't look like an outright collapse, the end of the world, market crash, all that kind of stuff. That doesn't look like that's what's going to happen. We're probably going to get much more stability, but it's going to have to be earned. There's going to be a lot of work technically to do in these markets, which I'll cover in the Substack newsletter. Looking at the NASDAQ, looks very similar in formation. It's a little bit more of a head. We already have crossed through the first derivative on PPM1. PPM2 is about to go there. We still have a decent upward slope. You can see the NASDAQ forecast, the red dots are forecasting into the future. It's showing that we hold around the 10-period moving average, which it should, and then we start to fade down towards the 21. That'll put us down around 17,000. And my expectations are that we'll see a lot of the Mag 7 stocks and other top-end stocks will start to also correct and trade in this sloppy sideways range. Some of them might really unwind. We'll see what happens over the next several weeks. But this profile is still more bullish than you think. You want to get bearish, be careful, especially since the market's already went down to the level that it has, and there is solid support at these levels. Now, this is a much more interesting chart, and we'll talk about interest rates going up on a couple levels. We'll look at the front end of the yield curve, potential moves by the Fed, but starting with the 10-year, it is forecasting that we're ultimately going to move down towards 3.75, 3.5%. And on the front end of the curve, I had originally forecasted that I thought we would see the interest rates move down in November. It now does look like there's a better than even chance that we're going to see some move in September. I was definitely pushing towards not only November, but actually into 2025. That forecast has changed a little bit. I'll show you in more detail in a minute. Now, we do have a little bit of a minor V bottom coming here in interest rates, but I think the same thing as I talked about in the patterns here, we should trade below this 10-period moving average here and above the 40. And so right now, those values are, in rough numbers, 325 on the extreme downside, and on the upside, that is 4.16. So we're going to continue to just trade down into this range, and then it does appear, at least from the forecast, this is likely to change as we get into early next year. But right now, it's forecasting that the long end of the curve could go as low basically as 2.8. I think that's a little overdone, but we do also have Fibonacci targets down here suggesting a min right now at 3.75, and then Fib target 2 is around 309, and then we have Fib target 3 around 275, which I think is a little beyond. I think that 40-period moving average will hold this. Now let's look at the long-term Fed funds. So looking at this forecast, I have shown you this forecast before. This is forecasting now that we are going to start to see declines as we come into September. And we're looking at coming down to 5% to 5.25%, so 0.25% there. And then as we come into November, we're looking at down to 4.75, as you would expect. And then as we come into December, we're looking around the 4.5 to 4.75 should be where the Fed sticks the Fed funds. So this is really a drastic forecast, but I went through a lot of details in a video I did a number of weeks ago called Forecast as to Zero. Every time we've had these flat periods like what we've had where Fed has held rates even at the bottom or the top, we see these massive turnaround moves, and these are sustained moves that happen every time. They're oftentimes a year and a half to 2 years or longer, and some of them, if you go back and watch that video, the algos are forecasting interest rates to zero. And if I forecasted this out, it would come all the way back down to this 200-period moving average, 1.5. And we'll see how this plays out. The moving averages that come into play will be substantial. You can see the curves that are also being forecast. So the dotted lines are what's being forecasted for the moving averages. And I went through that video. It is spot on these forecasts going forward. So go back and watch that. I'll see if I can link that video somehow, put it in the description. Okay, folks, that's going to do it for this video tonight. Thank you so much for watching. Have a great day trading. We'll talk to you soon.